Okay, so you want to own an apartment building. Find a solid property in a decent neighborhood. Buy it. Put tenants in every unit and watch them pay down your mortgage every month while the building quietly appreciates underneath you. Mailbox money, passive income, a machine that works while you sleep, your name on the lease, 240 rent checks hitting your account on the first of the month while you do something else entirely. That's the picture. And honestly, it's not a bad picture. That's exactly what apartment ownership looks like from the outside. And there are people for whom it genuinely works that way. But here's the thing, the rent check isn't the business. In December 2021, a man named Gajavelli posted a video online for prospective investors in his company, Applesway Investment Group. He was standing in front of a 704-unit apartment complex in Houston, Texas called Timber Ridge. He'd just bought it for $56.7 million. The complex looked clean. There was a swimming pool. He was going to renovate the units, raise the rents, charge tenants extra for covered carports and washing machines, and more than double his investors' money. "I never worry about the economy now," he told a webinar of prospective backers. "Even if the economy goes down, still, I make money." What he hadn't modeled was the sentence buried inside every loan document he had just signed. Some apartment buildings genuinely build wealth. Some look profitable on paper while quietly bleeding their owners dry. And some destroy people who never saw what was sitting inside the capital structure. By the end of this, you'll know exactly what happened to Gajavelli and which kind you'd be buying. 6 months before that Timber Ridge video, Gajavelli had already bought another building, the Estates at West Chase, 307 units, Houston's West Chase Business District, built in 1980, part of a 4-building portfolio totaling 1,330 apartments, that he and a group of co-investors picked up for $119 million combined. The Estates alone, a 2-story brick garden complex off Hayes Road, workforce housing, every unit renting for under $1,000 a month, was the exact property any motivated mid-level investor could look at and immediately see the logic in. And here's the thing, the logic was real. What Gajavelli was running is called a value-add multifamily acquisition, not a landlord play, a manufacturing play. You find a building that's underperforming its market, rents below what nearby units get, deferred maintenance, maybe a previous owner who just stopped caring. You buy it, renovate it, raise the rents, and sell it at a higher valuation 3 to 5 years later. The raw material is depreciated real estate. The finished product is stabilized cash flow. Gajavelli was doing this across 7,000 units in Houston. He wasn't fringe. He wasn't some amateur with a real estate influencer course. He was one of the city's largest landlords, running $500 million in apartment buildings. The logic was sound. The property was real. The plan was working. What nobody had priced was the sentence inside the loan. Here's what the Estates at West Chase actually cost to get into. The 4-building West Chase portfolio, $119 million in 2021. Roughly $89,000 per unit. Scale that to the estate's 307 units, and you're looking at roughly $27 to $28 million for that single building. You cannot finance a commercial multifamily acquisition like that with a standard 30-year mortgage. That product doesn't exist at this scale. So you go to the bridge loan market, short-term floating rate debt designed to carry you through the renovation and lease-up period, until you can refinance into permanent, long-term financing. Applesway and its partners borrowed more than $100 million from a company called Arbor Realty Trust across the 4 West Chase buildings. Loan-to-value ratio, above 80%. 80 cents of debt for every dollar of property. At the initial interest rate of around 3.4%, the math is genuinely attractive. Cheap debt, rising rents, appreciating asset, refinance in 2 years into a fixed-rate loan and hold it forever. Beautiful plan, standard plan. The plan every successful value-add operator was running in 2021. Here's what was sitting inside the loan document: a rate cap, a financial instrument you buy at closing that sets a ceiling on your interest rate for a defined period, usually 2 to 3 years. In mid-2021, those caps were cheap. Rates had been near zero for over a year. Nobody was seriously pricing for a sustained rate hike cycle, so Gajavelli bought his caps, paid a reasonable premium, and moved on. What those caps contained wasn't a protection. It was a clock, and it had already started running the second he signed. He just didn't know yet what happened when it ran out. Here's what a building like the Estates at West Chase actually earns: 307 units, rents averaging around $850 to $900 a month on a mix of 1, 2, and 3 bedrooms. At full occupancy, gross potential rent of roughly $3.1 to $3.3 million a year. That number has a name: potential gross income. It is the most optimistic revenue figure you will ever see on a pro forma. Nothing runs at full occupancy. The honest version is effective gross income, what you actually collect after vacancy and tenants who simply don't pay. At 9% vacancy, you're down to about $3 million in collected revenue. But apartments earn more than rent alone. First edition, most owners undercount late fees. On a 307-unit workforce property, $50,000 to $80,000 a year in a stable operation. Second, pet fees, parking premiums, covered carport charges, exactly the fees Gajavelli was pitching, which on a property this size adds $100,000 to $150,000 annually once fully implemented. Third, and the one almost nobody accounts for in the pitch, ratio utility billing, where you pass a proportional share of the building's water, gas, and trash costs back to tenants instead of absorbing them yourself. On a building this size, that shift alone reclaims $150,000 to $200,000 a year that was previously going straight out of the owner's pocket. Total effective revenue on a stable, well-run version of the Estates at West Chase, somewhere around $3.2 to $3.4 million a year. Now here's the number that looked like good news and wasn't. In early 2024, the West Chase portfolio was reporting an occupancy rate of 88%. The surrounding submarket sat at 89%. The buildings were basically full. That number reads as a healthy operation. The debt service coverage ratio was 0.69. That's the real number. DSCR, debt service coverage ratio, is the ratio of what the property earns to what it owes the lender every single month. A DSCR of 1.0 means you're exactly breaking even on the debt. A DSCR of 0.69 means for every dollar the bank is owed, the property is generating 69 cents. The buildings weren't in distress because they were empty. They were in distress because of what was consuming the income before a single dollar reached Gajavelli. Here's what was consuming it. The operating cost structure on a 307-unit workforce property does not negotiate. Property taxes on a $27 to $28 million acquisition in Harris County, Texas, roughly $500,000 to $600,000 a year. Insurance on a mid-sized Houston complex in 2022 and 2023, $250,000 to $350,000 annually. Gulf Coast markets saw premiums jump 30 to 50% in 2 years. Property management, the fee paid to the company handling leasing, maintenance, and collections, 8 to 10% of revenue, which on this building is $240,000 to $300,000 a year. On-site payroll, a manager, a maintenance tech, a leasing agent, $150,000 to $200,000. Utilities the building carries directly, $100,000 to $150,000. And then there's the number that almost never makes it into the acquisition pitch: capital expenditure reserves. Every apartment building is a collection of refrigerators, HVAC units, water heaters, roofs, plumbing stacks, parking surfaces, and appliances all aging simultaneously and all eventually failing. The industry standard is $300 to $400 per unit per year in reserve. On 307 units, that's $90,000 to $120,000 a year that never touches revenue and almost never appears in optimistic underwriting. Total operating expenses on a stable, competently run estates at West Chase, $1.5 to $1.7 million a year. Set that against $3.2 million in revenue and the NOI, net operating income, the number that determines what this building is worth and what debt it can carry, lands around $1.5 million annually. At 3.4% interest on the proportional West Chase debt, that NOI barely covers the payment. DSCR just above 1.0. Not getting rich, but surviving. And then the Federal Reserve started raising interest rates, and the clock ran out. March 2022. The Federal Reserve raises its benchmark rate for the first time in 4 years. Then May, June, July. By November 2022, the rate had moved from near zero to nearly 4%. By July 2023, it sat at 5.25%, 525 basis points in 16 months. The fastest rate hike cycle in 40 years. Gajavelli's loans were floating rate instruments with monthly adjustments. Every time the Fed moved, his debt service payment moved with it. By the time the hike stopped, the interest rate on at least one of Applesway's loans had gone from 3.4% to around 8%, according to data from TREP. A debt cost that had more than doubled, on an NOI that had not moved. Remember the rate cap, the protection he bought at closing, that clock that was running. Here's what happens when it expires. You have to buy a new one, at whatever the current market price is for protection against current rate levels. In 2021, a rate cap on a $25 million floating rate loan might cost $50,000 to $60,000. By 2023, the same protection cost closer to $700,000 to $800,000. Let that sit for a second. A budget line that was a rounding error in 2021 had become a capital expenditure large enough to consume an entire year of free cash flow in a single transaction. That was the sentence in the loan document. That was what the clock was counting toward, and it arrived exactly on schedule. At Timber Ridge, the building from the video, the one with the clean pool and the confident pitch, by summer 2022, the pool water had turned a sickly green. Trash piled in the parking lot. Maintenance requests went unanswered. AC units broke and stayed broken through a Houston summer. Occupancy fell from 94% to 54% by fall of 2022. Tenants left. Revenue dropped. Debt payments climbed. The gap widened every month. On March 13, 2023, Arbor Realty Trust initiated foreclosure proceedings against Applesway's first Houston portfolio. On April 4, 2023, all 4 complexes went to auction in Harris County. No outside bidders appeared. Arbor took the buildings back. $229 million in property. Gone in one morning. The investors who had put their savings into Gajavelli's deals lost everything they'd put in. And this is the part nobody talks about when they tell this story. In February 2024, the West Chase portfolio went 30 days delinquent on its $60 million loan. DSCR 0.69. Foreclosure proceedings on the estates at West Chase initiated April 2024. A newly incorporated entity called AWC Opportunity Partners bought all 4 West Chase buildings at a discount of just 5% to what Gajavelli had paid. Who financed that purchase? Arbor Realty Trust. Stop there, because that detail is the entire answer to who actually walks away from this thing with money. Arbor collected origination fees when Gajavelli signed the loans, collected interest payments while the buildings were operating, foreclosed when payments stopped, then immediately lent money to the next buyer of the same buildings, collecting new origination fees on the same collateral. The lender was getting paid at every single point in this story. The equity investors lost their principal entirely. This is not an accident. It is the structure. Debt is senior to equity. In every scenario, good year, bad year, foreclosure, total wipeout, the lender gets paid first. Always. The equity owner gets what remains. In a heavily leveraged deal in a distressed environment, what remains is often nothing. There's one more mechanism that runs quietly, even for a losing owner: depreciation. The IRS allows apartment building owners to deduct a paper loss based on the theoretical wear and tear of the structure, amortized over 27.5 years. On a $28 million building, that's roughly $900,000 a year in a non-cash deduction that reduces the owner's taxable income from other sources. You can be generating a cash loss on the property and simultaneously booking a tax shield against your salary. This is why wealthy owners sometimes hold apartment buildings with thin or negative cash flow, because the paper loss has real value to someone in a high bracket. Gajavelli's investors weren't in that bracket. The depreciation play was built for a different kind of buyer, which brings us to the version of this that actually works. A mid-size apartment building, purchased at a reasonable basis, $100,000 to $150,000 per unit, with a fixed-rate loan at 60 to 65% leverage, in a market with stable demand and no wave of new competing supply, can generate a cash-on-cash return of 5 to 8% in a solid operating year. On a 150-unit building acquired for $18 million, that's $90,000 to $140,000 in actual annual cash flow. Not the rent check fantasy, but real, durable, and compounding if you hold long enough. In a bad year, a major capital event, a roof replacement that wasn't reserved for, an insurance spike, a new building opening a block away and pulling your best tenants, that same property might generate nothing, or require cash from your own pocket to cover the debt while producing zero return. Here is the thing that almost nobody says plainly. The difference between a great apartment investment and a financial trap is almost never the property. It is almost always the capital structure built on top of it. Fixed-rate debt changes everything. 65% leverage instead of 80 changes everything. A 2-year renovation timeline with cash reserves changes everything. The building is almost never the variable. The loan is almost always the variable. Gajavelli's buildings weren't terrible properties. The estates at Westchase was housing 307 families through every year of this story. It is still occupied today. The new owner bought it at a discount, financed it at current rates, and is running it. The building survived. The equity structure Gajavelli built on top of it did not. Green Street, the real estate analytics firm, estimated that apartment building values fell more than 20% from their 2021 peak. On an 80% leveraged acquisition, a 20% value decline wipes out 100% of the equity. Not a bad year. Total wipeout. That's not bad luck. That is math. That's what leverage does when it runs in the wrong direction. Jay Gajavelli posted that investor video in December 2021. The pool at Timber Ridge was still clear. He was confident. The pitch was logical. The property was real. He wasn't lying. He was wrong about one thing, one sentence, inside the loan document, the rate cap expiration date. An apartment building is not a mailbox. It is a leveraged operating asset whose cash flow, value, and owner survival depend entirely on the spread between what the property earns and what the debt costs. When those move together, it looks like the fantasy from the outside. When they move apart, and sometimes they move apart for reasons entirely outside your control, it looks like a foreclosure auction in Harris County, Texas, with no outside bidders and the lender walking away with your building and a new origination fee. The building keeps standing. The lender keeps getting paid. Gajavelli signed the clock in 2021. He just didn't hear it ticking.